Hey guys, welcome back to another stream. So this one, it's a bit special, kind of, not really, but pretty much title this Emergency VF. Okay, there's a lot of tabs here, but Emergency VF analysis. So pretty much I have a large amount of holdings in VF, and I bought in over, I think, the course of the past 6 months. Got in around $16 and then got in again around 15 and then again at 13. So pretty much I've lost about $5,000. What's this? So yeah, pretty much. Oh man, this froze. Okay. I lost quite a bit of money, and I want to do this stream to figure out whether or not I should sell my holdings and kind of see where I'm positioned at. Okay. I think I should have a Baron subscription. Let me see. Yeah, here we go. Downgraded shares. She wrote in a research note that we believe that a slower path to stabilization and recovery is likely to result in lower margin and net profit delivery. Okay, so that's kind of the space at where we're at here. They're lower down to $14, $15.50, and this was back in February. So it's been about 2 months now. I'm sure that things have changed, and now the stock price is even lower. So that's kind of where we're at right now. What I wanted to do is compare this with other companies. So compare this with other companies and kind of see what... Okay, let's go to Excel. I'm gonna open up Excel and then new... Okay. Consolidated balance sheet. First, I'll maybe want to compare the balance sheet of these different companies. So first one I have is Hanes brand. So Hanes brand, the Hanes brand has been going through a rough patch recently. I think, let's take a look. So Hanes brand, consolidated balance sheet. All right, December 30th, 2023, the company has about 3 billion. I think this is in thousands. So 3 billion in long-term debt. Does not have any current portion of long-term debts. You also have lease liabilities. Lease liabilities non-current. Okay, so you have debt to equity. So ratios, debt to book value equity. So we take long-term debts, divide that by total stockholders' equity. Yeah, that's a lot. So there's 7.7. And let's take a look at, I think Colombia was another one I wanted to look at. Oh, I believe I actually also have this one too. Let's save this. So Zing Fund, company reports, Haynes financials, 2023. So fiscal year 2023.
Hey, O'Brien.
Yeah.
Can I open the door?
Yeah, what's up?
Real quick, new board draw.
Alright, team, we're going to be reviewing the new client slide deck this afternoon. And get a haircut.
What?
At least someone noticed. Yeah. Thanks.
Ryan, is that why I haven't been able to get a hold of you for like the last 3 hours?
Ryan, did you get a haircut since our meeting this morning?
Well, yeah, it was a little slow, and I got one after our morning meeting, so...
Okay, you can't just get a haircut on company time.
Okay, well, my hair grows on company time, so I don't know what, like...
Are you joking, Brian?
Are you guys joking?
No.
Alright, team, we're going to be reviewing.
What the?
Oh my god, is it a condom?
A lens wipe, microfiber lens wipe.
My hair grows on company time, so yeah.
Damn. Financials. Okay, 2023. Alright, let me see real quick. Okay, so we have let's take a look here. Ooh, shit. Okay. Alright, let me just pull this in. I wonder if I could. I don't know why this is. I don't know why this is doing that. Okay, maybe something like this. Okay. So it seems like this company, it was mentioned in their annual report, they actually have a very low amount of debt. Honestly, not even a single line item for debt. So the company is very equity heavy, and most of the liabilities come from accounts payable, accrue liabilities, so any current liabilities, and then there's a bit of operating lease liabilities. I'm assuming that has to do with leases the company signs on its various in-person brick and mortar stores. So debt to equity doesn't, probably zero. Okay. So we have Colombia. Haynes, right? And then the other one I wanted to take a look at is, let's do PVH. SEC filings. Oh, it's Jenny. Okay, so annual filings, let's do that. 10K, just got released a few days ago, that's tough. How do we open this? All right. So here we go. Oops. Part 2, part 1. Nope. Tommy Hilfiger. Okay, it breaks this down. Oh, 8 billion. Oh, okay, yeah, that's 8 billion. Percent of revenue, D8, goodwill impairments. Okay, so Tommy Hilfiger seems to be very profitable. This one, decline in revenues. SG&A, percent of revenue, goodwill impairments. Okay, there's an extra goodwill impairment. We also have gross profits, SG&A, additional cash. So operations, comprehensive income. All right, here's probably what we want. PVH. Summary financials. Okay. It's 2024 and then 2023. Okay. So this case, they do have a sizable portion of assets and a sizable portion of long-term debts. Okay. So ratios, debt to equity, we have short-term borrowings, doesn't exist, so I'm gonna add that still. Current portion of long-term debts, long-term debts, and then we will add all of that up and also then divide by cumulative comprehensive loss, total stockholders equity. So why is there, okay, I guess this is just 0. All right, so PVH has a very low debt to equity. I think VFC has a relatively high debt to equity ratio. Financial statements. So I think probably have to take a look at their quarterly actually, which I don't have. FVF, oh, actually I might. Like quarterly Q3. Yeah, I do have it actually. All right. Consolidated balance sheets. Okay. So this is December. Billy Kimba. Okay. So we have this. Let's take a look at debt to equity. So we have short-term borrowings plus current portion of long-term debts. So that is something to remember. And then long-term debts divided by stockholders' equity. Okay, so I guess it isn't huge. Relative to a company like Haynes, where they really have a huge amount of debt relative to the equity in the company. Yeah, that's rough. So hopefully VF Corp's stock price won't be going down to zero. It's still going to be able to make its debt payments. Interest coverage. Yeah, I guess you could call this like a cross-sectional analysis. So I want to create like a summary to interest coverage. Maybe asset turnover. This is something I learned about in class. Down. Okay, gotta leave in for a sec. Just to come on, my friend in. Alright, so where were we? Take a look at the summary financials. Let me delete this. So we have VFC's balance sheet. Oops, getting a call. Hey. Hey, is that okay? Maybe I call you back later. Getting on stream for a bit. Or I can unmute myself. Okay. I'm gonna go back to my room. Bye for now. Bye. What? Back to my room. Back to the stream. Okay. Gonna mute myself. Bye. Okay, so just thinking maybe I should add a bunch of other companies too. So let's take a look. We have Contour Brands. Levi Strauss. Who owns? Oh yeah, I think American Eagle as well. So American Eagle, CC filings. Okay, so let's bring this in here. Income statement. Alright, here we go. So I might bring this in. Right. So American Eagle. Okay. Delete all that. So call this the balance sheet. Insert. Oh shoot. Okay. So we got that, and then the consolidated statement of operations. I think we could probably use this. Okay. So delete this, and then also consolidated statement of cash flows. All right. Okay. So we have all of these accounts, which is helpful. Let's column width. Let's bump this up to 15. All right. So cash and cash equivalents. Let's do maybe some summary ratios. We have debt to equity. So this is American Eagle, right? All right. They have their accounts payable. No current portion of long-term debt. long-term debt net, so, okay. Wait a minute. Find this hard to believe, so liabilities total. Yeah, wait, where? Okay, I'm trying to find where I saved the, oops. Oh, here it is. Okay. Wait, this is VF. Nope, do not want that. I think this is AEO. Actually, man, I lost track of all of them. Okay, here it is. Total non-current liabilities, non-current operating lease liabilities. Okay, so that's where it's at. Okay, oh, I see. So you add up all of these together. All right, so long-term debt nets. I assume that's they spent payments to acquire productive assets, short-term investments, proceeds from line of credits. Okay. $870,000, $837,000. Proceeds, issuance of share base. Okay. Payments of dividends. I wonder what this 8,000. How come this ended up going from this to 0? But I guess that's not the point. Debt to equity. It seems like it's just 0. So it's equal to long-term debts. There is no. Maybe current portion of operating lease liabilities, but I wouldn't count that for now. Divided by total stockholder equity. Okay. So we just have to take, I believe, what we really want is right, just 0. All right, there we go. So we have debt to equity of just 0. Okay. We also have, I believe here, okay, I have a lot. I'm gonna open this up side by side so we have like 2 different views here. Okay, I think this should be better. Alright, gonna exit out of here. It's the one beneath this. Exit out of this one too. Alright. So now we've cleaned this up just a little bit. Drag this down. Okay. VF. Oh, what's good, Andre? It's VF Corporation, the company that owns Supreme and Timberland, North Face, Vans, all those companies. Okay, so PVH. Let's take a look at Levi's. Levi's SEC filings. types, annual filings. Oh man. Okay, oh, here we go. So let's take this. I wonder if, do they have a quarterly report? Okay, they do actually. Consolidated balance sheets, so unaudited. Trust it. Levi's. Income statement. Okay. So copied cells, shift down. Okay, insert, oops. Alright, so we have consolidated statement of operations. Just in a single quarter alone, Levi's was able to do about 1.5 billion in sales. It seems like column width, say 15. So there is a sort of decline in some sales, cost of goods sold. I'd assume scales with inventory, so that's reduced. All right. Gross profits has also reduced. Selling general administrative has surprisingly increased. Restructuring charges, so you had a net loss about 10 million. Okay. Consolidated balance sheet. All right, so we have current liabilities, accounts payable, short-term operating lease liabilities, long-term operating lease long-term debt. So not too much, really, actually. Let's do summary debt to equity, which is equal to, let's see, long-term debts. We divide that by stockholders' equity, which is, yeah, not about a half. So it's around the average, it seems like. Contour brands. I wonder if there's a, let's see. So stock screener. Market, US, it's fine. It's gotta be like a sector overview, right? Watch this. Oh man. Security info, industry. Okay. Levi Strauss. Okay. Yeah, this is rough. I might need to switch over to my current screen. think I'm gonna do that, and then just use the top screen as. Okay, so let's update this Mac OS screen capture. Alright, let's move to the bottom. Okay, there we go. So I think let's take a look at the industry. Consumer. What is it, like apparel manufacturing? Manufacturing. Okay, apparel, footwear. So Hermes, wow, is actually pretty high up there. A6, okay. You have Deckers, Outdoors, Ralph Lauren, Skechers, Birkenstock, Levi's, Crocs. Crocs is more valuable than VF. That's insane. So PVH Corp, Gildan Activewear, Burberry, VF Corporation, Columbia Sportswear, Under Armour. Yeah, Under Armour is only worth 2.7. It's interesting. Oxford Industries, Guess, G3 Apparel, Dr. Martens PLC, Wolverine Worldwide, Lanvin, Vera Bradley, Rocky. Vince Delta Apparel. Oh, Super Dry is traded. Interesting. What's it called? There's the one company that owns UGG and some other. Okay, what is that one called? UGG. UGG owner. UGG parent company. Oh, Deckers Brands. Okay. Deckers Brands. SEC filings. Filing dates. $10Q. Okay. It's probably going to be their most helpful one then. Bring this in here. Balance sheets. Nice. Okay. Why is this? Okay, so let's try this. Oh wow, yeah, that's weird. Okay, so there's a weird column here. Just delete it. All right, property and equipment nets of accumulated depreciation. Okay. So let's see what liabilities. Doesn't seem to be any long-term liabilities, long-term debt. cash flow. Okay. Let's take a look here at the cash flow. Purchases of plant, property, and equipment, net cash used in investing, loan origination, issuance of stock, purchase of common stock, cash paid for shares withheld for taxes. Okay, yeah, so this company has absolutely no debt, which is very impressive. All right. So there are companies, it seems like, that don't use debts, and there are companies that do use debts in this apparel industry. Alright, I'm gonna get rid of these merge cells. Nice, okay. So we have that. Thing commitments and contingencies. Is there a operating income table? Options, nope. Okay, let's see. It's gotta be some income statement type. It doesn't seem like there is actually. Damn, that's crazy. Table 3. Comprehensive income. What's this? Nope. Stockholders' equity. Now, there really is not much. Realized gain. Net sales. Okay, I think this is probably best I'll get. Should be the same thing, right? This is just an income statement. Okay. Nice. Okay, just delete all this stuff. Okay, nice. So we have net sales about 1 million in just a quarter actually, so that's a lot. Comprehensive income, net income per share. Earnings per share, wow. That is a really high earnings per share. So you have 389 million, and it seems like you have cash and cash equivalents of about $1 billion. So I'd be surprised to see what, yeah. Let me take a look here at my slides, by the way, from my class, see if there's anything interesting, takeaways that I can get. Financial ratio analysis, maybe. Asset turnover. What is the average total assets? So what is average total assets and return in asset turnover formula? Okay, so now I have all of these companies here, and I have some of their data, but now I'm kind of at a loss of like what do I need to look at in order to kind of evaluate the company here, right? So PVH has a debt to equity. So let's see here. Summary financials. Okay, so we have debt to equity. Then we have Haynes, PVH, Columbia, VFC, that's the American Eagle, Levi's, Contour, I think the one I just did was for Deckers. Right, and then VFC. Maybe I might do this like so. So we have Haynes. Maybe you could do it like this actually. That's equity. So we have companies. PVH. American Eagle. I think it's fairly low. That's 0. Also, Columbia is also 0. But let me do this. Columbia. Debt to equity is equal to cash equivalents. So we have, yeah, there's absolutely no equity or no debt here. Long-term debts 0. So 0, 0 divided by totals. Issued. I think this is good. Okay. Levi's. Contour. I think this is Deckers. Deckers. Deckers we have, let's take a look. Total long-term operating lease liabilities. There's also no debts. Wait, let's take a look. Their annual report. Debt. Okay, so it seems like it seems like there is really no long-term debt here. Finances with their existing cash and revolving credit facility. So that's really strong for this company. Okay. Debts to equity. What happened? No.
Okay, you can go back to stream.
Okay. Bye. Okay, so debt to equity. Add on here, so we have long-term debts 0, 0 to equity is equal to 0 divided by total stockholders equity. All right. So current S, yeah, we have almost a 3 long-term. All right, 3 times the amount in debt to equity. To revenue. Trailing 12 months. Yeah. Net income. TTM. PS. TTM. Okay. So I think Haynes annual. Okay, no, we do not have anything on that yet. All right, that's okay. So Contour, Deckers is also 0. Okay, so let's take a look at the, what should I do here? See what we have. So we have Columbia, VFC, Haynes, American Eagle. All right, I think 12 months ended. Okay. So this is in millions. So this, yeah, this is in thousands. We could divide this by 100. Get 1,000. Yeah. Okay, so we have to divide that by 1,000, and okay. So and then net income. American Eagle, we had. Okay, trailing 12 months, then operating income, Eagle, we take income from operations, nice, okay, so we divide by 1,000, divide by 1,000, so we have this in millions. So 3 billion sales, 300 million operating income, 251 net income. Should we also add free cash flow? Not entirely sure. Let's take a look at Levi's. Okay, so this is the consolidated income statement. All right, that is on a quarter by quarter basis. Deckers is also on a quarter by quarter basis. Okay. Levi's, TTM. Let me make all of these. Okay. So Levi's 0.51, right? And then, Levi's SEC filings. Seems promising. This is probably their income statement. Okay. Take this. So a bunch of these are merged cells too, so we can unmerge them, I think. All right. Let's do that. Let's add this here. Ooh, wait, does that work? Yeah, okay. It's cost of goods sold, gross profit, goodwill, and other asset impairment charges. So, goodwill impairments. We have 90 here. Operating income. Delete. Okay, shift up. Nice. Net income. Common stockholders. Wait, we could delete, shift this one up too, and then shift this one up as well. Okay. And then I think we could delete this. 3 months ended. Oops. Full year. Months ended. Okay. Yeah, I'm getting very tired right now. Oh my god. Okay, so 3 months ended, and 3 months ended. So this is, okay. Balance sheets. Yeah, I don't really need that. Cash flow. Maybe you could use this. Just add it for now. Okay. Gonna save this one. Okay. Let's see. So net revenues. Right, we didn't even add that one yet. Okay. So VFC, let's see, quarterly earnings calendar. I guess what I really want to know is VFC earnings announcement. Okay, so it's May. I think who else reports earnings here? American Eagle earnings. Yeah, I'm curious to see what this is like. So we have, oh wait, that is the one I do have, I believe. So we have, let's do market cap. Market cap. 4 billion. Okay, so 4.47. Actually, this is where the screener actually might be pretty helpful. So, oh man. Nike, LVMH, Moat, Hennessy, Hermes, Nike, Adidas. Okay, on to Deckers, Montclair, Shenzhou International. Never heard of that. So On Holdings, Ralph Lauren, Skechers, A6, Birkenstock is Levi Strauss. Okay, which I already have here. So Crocs. Crocs, Brunello, Cucinelli, Puma, Leaning, PVH, Gildan, Activewear, Burberry. Alright, and so that's kind of where VFC is between that. We have ABC Mart, interesting. So Guess is also on here. Canada Goose. Huh. Okay, I'll be back in a sec. Smart Ermin Kelta Sagna Columbia Sportswear. Okay. Ryohen Keikaku Hugo Boss Contour Brands Steve Madden Under Armour. Okay. Is American Eagle on here? No, it's not. All right. The Gap. Okay, here we go. Foot Locker, USD. Yeah, American Eagle. JD Sports.
Dude, keep it down.
Alright, I will. Yeah, good night. I just think it's a lot. Oops. Let's take a look. So we have market cap. Oh wait, here we go. Okay, market cap, market cap, market cap. Can we export this? I don't need this. 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 Okay. Target price. Wait. Market data. Is there like a fundamental financials? Basic EPS. Trailing 12 months. This is actually very helpful. Where's value to? Oh, so they do this every. Okay, so they already have these pre-built in. All right. Yeah, this is very helpful then. What does this say for VF? 5.32 divided by EBITDA. Yeah. Total revenue. Trailing 12 months. Operating income. Okay. Yeah, that's good. Ah, I see. Yeah, that is a substantial amount of net income. Damn. Okay. Yeah, Under Armour seems like another company which might be in a value trap, but company does have consistent revenue and income growth. Maybe not growth, but at least levels. Although this might be kind of concerning. I don't know why net income is higher. Okay, so financials, cash flow from operating activities. Okay, so net debt quarterly. So I'm gonna delete this. Okay, so revenue, operating income, net income, net debt to EBITDA, net debt, breaking stock. So net debt, I'm pretty sure is total debt minus cash, total assets, total equity. So cash flow from operating activities. Trailing 12 months. Free cash flow. Net debts. Right. Valuation. Price to earnings to growth. Price to free cash flow. EBIT ratio. Hugo Boss. 0.32. So it doesn't really seem that undervalued compared to. Yeah, I wonder how they calculate enterprise value. Maybe market value of debt plus market value of equity. Okay, EV to revenue. Valuation, when you take a look at, let's take a price to earnings, price to book, price to cash flow, price to sales. Yeah, VF is even lower, 0.44. Haynes brand is still selling a lot. Valuation. Price to earnings. Montclair is it profitable? Skechers 16. So Adidas also isn't profitable. Interesting. I'm surprised the operating income is that low. See filings. IFRS, okay. Other operating expenses? What is other operating expenses? Marketing and point of sale expenses decreased 8% to. Alright, so Nike is a lot more profitable than Adidas. Okay. I wonder if I can download this. Trading view export chart data. Export screener. Trading view export screener. CSV. Okay. Export screen results. Okay, it's 30-day free trial. Oh man, alright. Not entirely sure if I want this. Maybe for free trial, but I think my mind isn't really working anymore, so I'm gonna end the stream here. But honestly, thinking back to what we've done today, didn't really feel like I got much done. Spent a lot of time trying to do the Excel thing, where trying to compare all these different types of figures. That took a lot of time. I think this trading view chart was actually pretty helpful in gauging the actual position of VF Corp and the apparel footwear industry. And there's some valuation metrics here that we can see VF is doing okay on, and also doing pretty bad on, or just normal. Yeah. VF is super undervalued when you look at the price to sales, but PE ratio, they are one of the top companies within this. VF is the only non-profitable company, which I think has to do with the impairments of goodwill. I think at the end of the day, the company still is profitable, but net debt, yeah. I don't know. This number seems kind of suspect. Didn't realize it was that high. Yeah, but out of all the companies here, VF is definitely the company with the largest amount of debts. More than Adidas, though, damn. Even more than Nike. So Nike doesn't really finance a lot of stuff with that. Stock holding. Let's take a look at their financials. Maybe debt to equity. .49. I think that's something very, very close. So maybe these guys, these guys don't have 0 for all of them. I'm assuming maybe then they include operating leases as debt. What else? Current ratio. cash ratio, asset turnover. I think that's sales over average total assets. Inventory turnover. You want this to be as high as possible. Wait. Inventory turnover ratio. Oops. High means good. Nike has a 3.5 inventory turnover. Damn, nice. Pretty standard, it seems like, for VF. Just coverage. Just coverage expense. Think operating income divided by interest expense. Yeah, the companies with these signs have 0 debts. Okay, so yeah, I can see that biggest problem for VF is the interest payments has one of the lower interest coverage ratios in the entire industry. Right. So with that being said, I think fairly valued, honestly. Compared with Columbia. Look at EV revenue, EV to EBITDA. And I think it all stems down from the fact that there's 3.48 debt to equity, 0.21 debt to equity. There's a lot more debts. The company. This is on the higher end. Wow, yeah. I'm surprised Lululemon isn't on here. So we can find Lululemon on here. I feel like we should be coming up onto it soon. Retail trade. Yeah, interesting. I'm surprised they put that there. Urban Outfitters is also on there. Okay. PE ratio. It's for sure diluted. Option access. Okay. Wow, this is huge. Earnings per share diluted. AutoZone. Yeah, that's also pretty massive as well. It's pretty sure. Okay. So, yeah, I think I'm probably going to head out now. I think maybe some takeaways for today. You know, it's not 100% clear that VFC is currently being underpriced. You look at the EV to EBITDA and also EV to sales. Wait, how do I? Here we go. So when you look at these valuation metrics, EV to revenue, EBITDA, yeah, the companies up here do have higher valuations, but really it comes from growth prospects, and right now it's difficult to tell whether or not VF is going to be able to recover from their period of decline. So I guess we'll see what happens. I think $12 is still relatively cheap, and from a price to sales perspective compared to the other companies here. I wonder if there's another price to, let's say, price to earnings ratio, price to cash, price to book. And maybe this isn't super helpful, but would give an idea of what types of companies. Book value of equity, right? So the book value here is being crushed by okay. That's interesting. Doesn't even have a low book to value, price to book value. relative to the other companies. Okay. Alright. So with that, probably going to head out now. And thanks for tuning in. Probably pick this up tomorrow and see where I'm at with this. Alright. Peace.